Welcome, everybody, to Mortgage Talk with me. I'm here with Melissa. She has been in the business for how many years
Almost
again?
almost 6 years.
Almost 6 years. Okay. So I have come to know Melissa. She does amazing work, and she really does care about her clients the same way I do. So we have kind of clicked, and I look forward to doing more of these with her because we are both aligned in the sense that we want to educate the public. We don't care if you're our clients. We would love for you to be our clients, but that's not the whole objective of what we do and why we do these things. It's really just to ensure that people know what they're doing and they're making educated decisions and they're making good real estate decisions. So welcome, Melissa. I'm excited to chat with you today about renewals, which is a hot topic. Um, and I know that we just went through a renewal that was an absolute nightmare. And so I know there's a lot of questions that people are, there's just a lot of questions going on in their mind. There's lots of people. I think there's like 1.4 million Canadians or something, is it, that have renewals coming up this year, like 2026.
It's a big year.
Yeah. Yes. So, and I know a lot of people are asking themselves, okay, so I do have a renewal coming up this year. It's not until the end of the year. Should I start to be planning now? Should I just plan closer to the date? So let's maybe dive into like the timing of your renewal and why this actually matters. And yeah, we can kind of just go from there.
Sure. So first off, thank you very much for inviting me to speak today. I also look forward to doing this in future as well. Okay, so in terms of timeline, we can typically lock in a rate about 120 days or 4-ish months before your maturity date. Now, often what people think is if I'm locking in a rate that early, if rates drop, I'm stuck with this higher rate, which is not the case. Generally, what we're doing, we first want to put together the overall strategy. What are we trying to do? What lender are we taking this to? And then when we lock in a rate, we still have the opportunity, if absolutely needed, to pivot and go to a different lender during that time frame. We can also ask that same lender to reduce the rate if rates do drop. So we can ask them for that lower rate, usually all the way up to about a week before closing. Some lenders are even like 2 or 3 days before closing. So we do have a lot of flexibility there. But the most important part about starting the process early is that we're protecting you in the event that rates do increase. We are
Right.
living in crazy times right now. It is very difficult to predict what will happen. There's trade tensions and all kinds of other things happening. So it is possible that rates could on a dime increase by 20 or 30 basis points, which in plain language is like 0.2 to 0.3%, which on a small purchase is nothing. On a mortgage that's hundreds of thousands of dollars, that's a lot of money extra that it's costing you. So definitely important to start that process. I would say like a solid 4 to 5 months early to make sure that we have plenty of time to get you the best rate and terms and overall product for your specific situation.
I think too that maybe we need to just advise that. So you may have a mortgage with TD and it's coming up for renewal. You need to know your options in terms of you are not stuck with TD. A lot of people get that renewal email or renewal letter in the mail, and it's like, click the button and you're renewed and you're good to go. That is 9 times out of 10 the worst thing you can do in terms of just, hitting that easy button and knowing that you have an opportunity to negotiate, chat around with other, say, brokers or banks or whatever to try and find the best offer for you. You actually can, negotiate and talk to other people, because if you don't, you're just letting the banks lead you where it should be you leading where you go in terms of what is best for you, because the bank does not know what's best for you. And by talking to somebody like Melissa, who takes it to heart what is best for you and can understand your situation, I'm not saying all banks are like that, but when you're sitting in the bank office, you know, they've got quotas to meet and they are just there because they're getting paid to be there. Whereas, you know, somebody like Melissa, this is her livelihood. This is how she makes a living. And she cares about your outcome. So, do you want to maybe just touch on that in terms of like being able to, you know, shop around and not be stuck with where you are?
Sure. So that's a strategy that the banks put in place because it's path of least resistance. They offer super low rates usually on renewal because they don't want you to shop around. They don't want you looking around because they want to retain your business. And this is the easiest way to do that by just simply signing on the line. You don't have to think about it. It's very easy to just make that decision. The problem, though, is that when you are just signing on that line and not thinking about it, you are losing a lot of different opportunities that could be available. And what's really, really prevalent right now is that people are stressed about their mortgage payments. People are coming off of these super rock bottom rates from COVID times, like 2% rates, and they're stressing because now they're going to a 4% rate and things were already tight before. How am I going to afford this? So it is super important not to just sign back on that line because there are options available to make things more affordable that oftentimes people don't realize are available unless they start seeking out perhaps a broker's support to walk them through what those options could look like. And sometimes the lowest possible rate, actually more often the lowest possible rate, is not the best product for many people because there's all kinds of fine print and strings attached. Often it limits flexibility. You can't really improve cash flow at all. So it's really important to just take a beat when you get that renewal email. Yes, that rate may look attractive, but it's very important to look at the bigger picture, look at the overall financial situation and see how can we make things better? How can we work toward the goals that you might have? So take a beat, reach out to somebody else, get a second set of eyes on it and see if it is actually the best move for you. And sometimes it is. Sometimes signing back with your lender does make sense. Maybe your financial situation has changed. You've lost a job. You would no longer qualify with an A lender, and it's going to be more expensive for you to go somewhere else, and it doesn't make sense. Absolutely, it might make sense to sign that back. But it's important to still have someone look at that and say, yes, I think it does make sense to do that instead of just automatically assuming.
Yeah, for sure. Because it is the lack of education and the lack of knowledge. And if you are not in this industry and know it through and through, like us, there may be loopholes that you'd be like, oh, I didn't think of that. And I kind of forgot about that element or whatever. Whereas we're going to give you a whole full circle analysis basically of your situation, more so Melissa with the mortgage aspect of things. But you know, it's so important, and I cannot stress this enough, to have the proper education behind this, because you could financially cause some problems in your future when you make these decisions and you think maybe you know the best. But I highly recommend you get a second or third opinion once in a while, because it is going to definitely give you peace of mind, and you'll know when you're talking to people if they've got your best interests at heart. And I think your gut is usually pretty good with that, knowing that this person actually does care about me, so I can trust them. So having somebody that you trust is really important.
Absolutely.
Now, one thing that I just wrote down, because I was like, if I don't write this down, I'm going to forget, is options to roll in high interest debt. So myself just went through this, had a lot of high interest debt, and was able to roll it in. Ideal situation? No. That story's for another day, in terms of putting yourself in debt and making, doing things that maybe financially are detrimental to your financial future. Been there, done that, learned it. And I'm sure I'm not the only person, but if I can be somebody to just be mindful of what you're spending your money on. I wouldn't have been in this situation had I done that. But yeah, so being able to roll in debt into a new mortgage or a refinance is also an option that is a very smart option for, cash flow purposes. So maybe you want to just touch on that.
That is actually my area of specialty, is taking a look at the overall financial picture and seeing how we can improve cash flow. The number one way of doing that is by rolling in high interest debts like credit cards, lines of credit. There's specific loan places that sometimes people will resort to help them in the interim with cash flow, but those products often come with very, very high interest rates, like 30 to 40%. It's crazy how high some of those interest
Not
rates
ideal.
actually are. So definitely not ideal. And a lot of times, if there's equity available in the house, we can roll in some or all of that debt into the mortgage, which doesn't upfront, it doesn't sound like a great idea. You're taking all this debt and you're moving it into your mortgage. It's going to take you forever to pay it off. But what I then do, so often this improves cash flow significantly. I've had instances where people have saved over $2,000 a month in cash flow just because we just moved the debt from one place to another. Now monthly cash flows significantly improved. Then we create a strategy for them to pay their mortgage off faster. So how do we do that? We want to take that $2,000. We don't want to put it all on the mortgage because then they're going to end up in that exact same situation again. So we want money to start going to savings. So this is where I might introduce them to like a financial advisor or financial planner so that they can start putting money in some investments and into savings, make sure they have appropriate life insurance and they're well protected and they've got a well-rounded plan. Then we look at what's left over at the end of the month. If they've got $300 or $400 or $500 that they could put onto their mortgage, we can then create a strategy. And I can map this out with a report showing them if you put $500 extra on your mortgage every month, this is how many years you'll pay it off faster. This is how many dollars you will save in interest over time. I've had some that they're saving $130,000 to $200,000 if they follow the plan. They're paying their mortgage off, 12 years sooner. That's 12 years of mortgage payments and debt payments that they won't have to make because everything got rolled into that mortgage. They will be debt free in that time instead of just trucking along, making those minimum payments, stuck in this hamster wheel where you're not ever getting any further ahead. This is a very clear, structured plan to get them out of that. So we're not going into this with the mentality of you can just use your house as an ATM and keep pulling out money and keep running up debt. This is a plan to get you out of it and live debt free. And I know that there is sometimes controversy about people paying off their mortgage early.
Personal preference, I think.
It could be invested differently and maybe get a higher rate of return. But in my life, I have never once spoken to somebody that was mortgage free that said that they regretted that decision.
Yeah.
Getting rid of that payment is usually a huge burden and it's a huge weight that's lifted for people.
Yeah.
So combining debt is usually the number one way of improving cash flow. We also look at things like if you do need to extend your amortization or the overall life of the mortgage, we can sometimes do that too. We look at a lot of different factors when we're putting together this entire plan to see what works best. So do you need your amortization extended? Do you need to change how often you make your payments? Maybe you make your payments accelerated biweekly right now, meaning you're putting more money onto the principal. Cash flow doesn't allow for that anymore. Maybe we scale you back to just regular biweekly or monthly payments to help ease that extra little bit. Then we look at rolling in high interest debts where possible, and we come up with an overall strategy to improve your life and overall financial situation.
Yeah. And I think it's worth noting, and I know I say this a lot, but this is personal to you. This is the benefits that you have when you're working with somebody one-on-one. You can, give out your goals, your plans. You can kind of open up to what your financial situation looks like so that we, Melissa, can help you as best as you can, or as best as she can. And no case is the same. Everybody's financial situations are different. Employment, homes, all those things are all going to be different for everybody, which is why this is a customized approach, which is very beneficial to you. Whereas the banks, they just, I'm not speaking for the banks, but they may not have a more personalized approach, I will say, in that case.
I think what's important to note there is that because it's a customized approach, and every mortgage should be customized, like it should be specific to your circumstances. That's the problem when people look for lowest rates in like Facebook groups, for example,
Mhm.
asking what rate did everyone get for their renewal, which is a super hot topic right now. This is the question so many people are asking in all the different community groups. The problem with that is it's very much customized. So do you have an insured mortgage? Do you need to take out equity? Do you have a rental property, or is it just your home, your owner occupied property? Like how long is your amortization? There are so many different things that go into the rate that you're given by any lender, not just like your bank included, that asking someone else for their rate on Facebook or another community group, while it could be helpful to kind of gauge where rates are sitting, you'll never get that same rate necessarily because you have to qualify for it and you have to have a specific file type to match that. So often, like I said, when people are asking for those low rates, they don't necessarily realize that that's the case. And also, then there's the difference between fixed and variable. And a lot of people don't necessarily understand that when the Bank of Canada makes an announcement about rates, it doesn't actually directly tie to fixed rates. It's only specific to the overnight lending rate, which impacts prime, which impacts variable and home equity lines of credit and other products that are tied to prime. Fixed rates are actually tied to the bond market, which fluctuates hourly. It moves up and down all day long, and we watch for trends in the bond market, and that's where rates will go up or down. Sometimes there will be a spike and rates will increase rapidly by 0.2 to 0.3%, sometimes overnight, where nothing has happened in the variable world. Variable is just trucking along. So it's also important for people to realize that there is that difference, because a lot of people will hold on saying, I don't want to lock in a rate. I don't want to do anything yet. I'm waiting for the Bank of Canada to make their next announcement. Meanwhile, that person wanted fixed to start with, and maybe fixed has now gone up because they were waiting for something that won't actually impact them.
Yeah, exactly. That was something that I was always up in the air about, because everyone has their own opinions on fixed and variable, and again, this is more of a customized approach. What kind of risk level are you willing to endure, and do you need the stability of knowing what your payment is every month because your income maybe fluctuates? There's so many different things that can help you decide which one is right for you. I know that we are in a variable right now in our new mortgage. And one good thing about variable is you can lock it into a fixed. So it can't go from fixed to variable, but you can go from a variable to a fixed. So that does, open up options as well. But yeah, it's a case by case basis. You might say to me, because I'm in real estate, because your income is, up and down, and you can't handle risk and not knowing. So maybe a fixed, might be better for you, just in terms of what you're willing, like what your heart can handle kind of thing, right? As opposed to somebody who maybe has a salary, has the same income every month. And even with the variable changes, it probably won't change that significantly to impact, what you're able to do on your mortgage each month.
Just wanted to speak to locking in from variable to fixed very quickly. So common misconception is that when you are locking into a fix, that you get to keep the variable rate that you have, and that's what you're locking in at. Not the case. You have to take whatever the comparable fixed rate is at the time. And also it depends on the lender. Some lender will let you lock in for the remaining time you have left in your term. Others will make you lock into a brand new 5-year fixed. It really depends on the lender and their policies. So that's something to be very familiar with as well. And also just a nuance there in terms of penalties. So that's something that I look at very closely for fixed and variable and how they're calculated. So again, everyone's under the assumption that breaking a mortgage on a variable is just 3 months interest. But 3 months interest are not always calculated the same way. So one lender may calculate that based on their posted rate, which is significantly higher. Others may calculate it based on the contract rate, which is significantly lower. So those two penalties, the balance could be the same, the current rate and discount could be the same, but their penalties could be very different. They could be thousands of dollars apart. So again, it's important to make sure that you're understanding the product that you're actually selecting and what happens if I want to lock it into a fixed. Do I need to requalify? Do I lock into whatever time I have left, or am I locking into a 5-year fixed all over again? What does that penalty look like if I need to break my term early?
Mm-hmm.
These are not answers that banks and most lenders just willingly hand out. You have to know, ask those questions.
Yeah, for sure. Yeah, no, it's very important to know these things because yeah, if you're in a variable rate and you've been in it for a few years and you want to go fix because maybe the market's going wonky, like you potentially could be locking into a completely new mortgage. So these things are really important to know. And the only way I believe that you're really going to know these things are if you're going to talk to somebody like Melissa, who can just kind of give you an analysis of your situation. And maybe she can, offer you, what, your term is up in 2 years. It'd probably be more financially sound for you to wait the 2 years and then, look at your options in 2 years from now or whatever. Now, another thing that people are concerned about, I know that we went from a 1.84% interest rate, which was really, really nice, which is another reason why we held on to it as long as we did, because I was like, I don't want to let this go. I'm never going to see this ever again. But is no thinking, or people having this notion that, well, the interest rates are double, so now my mortgage is going to be double. And I don't think that's always the case. So maybe you can touch on that, because I know a lot of people are like, I can't afford, my mortgage is $4,000 right now. I can't afford $8,000 for a mortgage.
So it never actually works out to be double. We would have to know like the balance and stuff to kind of get an idea of what that will actually look like. There's lots of free calculators out there. You could put in your current balance, how many years you have left in your amortization, the rate that you have, the rate that you're going to, and you could do a comparison. It's pretty easy to do. I have an app that also allows people to do that for free. So generally speaking, if you're going from like a 2% interest to a 4% interest, your payments will not double. You will absolutely see a payment increase if you don't do anything else to change it. So that's where perhaps we could look at changing the amortization to make things more affordable in the meantime. So say you have 18 years left in your amortization. Maybe for this term, we have to extend it out to 25 or 30 years just so you can afford things. And then if rates come down, or, maybe income increases or debts come down, whatever the case is, at the end of your term, we can always look at changing that amortization again. Or if you've got extra money on a monthly basis, you could start chipping away at it and bring it back down. But it's a matter of just looking at what can you feasibly afford on a monthly basis, and how can we get you as close to that as possible, so that you're not stretched to your limit, relying on credit and falling behind.
Right. Absolutely. One thing I did just think of, because I know I was asked this question maybe a couple weeks ago, and they do have a renewal coming up this year, but they were considering switching jobs. Mm-hmm. And so, unless you're doing just a regular renewal, like just a straight renewal where there's no pre-qualifying, no nothing, you're not rolling debt in, you're not changing a whole lot. I don't think changing jobs would have an effect on that. But if you were changing jobs in the midst and you knew that, come October when your renewal comes up, you do want to roll in some high interest debt and you do want to do a few things, is that going to affect this scenario kind of thing?
Sometimes it depends. So If you're moving from a salary position to a new salary position, realistically, it doesn't even have to be in the same industry. You could do a complete 180, completely just choose a different industry altogether. If it's salary and you've received at least one pay stub prior to closing, and you can get that verified on the letter of employment, generally we don't have an issue there. Same would go for guaranteed hours. So if you're guaranteed 40 hours every single week at X dollar per hour, and you have a letter of employment to verify and you have a pay stub, generally we can get that by without issue. If you're changing industries and you're going to something that does not have guaranteed hours, usually that's a problem. We want to see a 2-year average of that. If your income fluctuates, we need to be able to show that it's consistent. If you're going from being employed regularly to becoming self-employed, again, could be an issue. Sometimes we can make a case if it's within the same industry, but these are all done on exceptions. So you want to make sure that you're looking at that super early and talk to somebody before you make those changes so that we can say, okay, this is what I anticipate will be required come renewal time. If we get to that point and you don't qualify, then yeah, we'll just say, hey, maybe you should just take the renewal. They don't qualify you for that. They just send it out. As long as you've made your mortgage payments and haven't really missed any, they're generally just going to give you a renewal offer. So in that case, maybe you just take the renewal, take a 2 or a 3-year term, and then we can reassess toward the end of that term where we think that placement should go.
Because then once, say they do their renewal, say they do like a straight renewal or whatever, it's like after that closes and after that is done, then you can go and switch your job or whatever you need to do, right? But you don't want to mess up your renewal because you made a change that could have, you don't want to do those things without having the knowledge of what it could impact for your renewal. And I don't think a lot of people maybe think that way. They just, they do whatever. And then they realize after they've done it, like, I had no idea this was going to affect, the renewal and that kind of thing. Like for me, even with our renewal, the way because I'm self-employed, the way I did my taxes and with my corporation and how I claimed my income through dividends and so on and so forth, I don't understand any of it. But there was mention that it could have been done differently and that would have helped me significantly. So these are things you don't know until sometimes the time has already passed or you're already in the situation where you're like, well, I wish I would have known. So sometimes, rolling in your accountant with your mortgage person can also be very beneficial so that your mortgage person can also talk to the accountant and say, look, this is kind of where we need the income to look or to be or whatever. I'm sure you've probably done these things where, you need to make a plan. You need to have a strategy in place. And if you don't have one, it could, potentially not benefit you.
For sure. Usually accountants, their goal is to try and save you the most amount of money in taxes. But what we can do is compare how much money would you be saving on your taxes if you were to claim lower income versus how much extra money are you going to be paying in interest because you've written your income down so low. If we can say that you're actually paying way more money in interest than you're saving in taxes, then it might make sense to boost your income up because you're going to end up saving more money in the end. Whereas maybe you're saving more money in taxes than you would be saving by taking a lower interest rate. Maybe it makes sense to just write your income down and we look at an alternative lender. So again, case by case basis, but those are definitely situations where we can actively talk to your accountant if you give permission, and we can kind of come up with a game plan that makes sense.
Yeah. So if you're in that position right now, just as an aside, and it's going to be tax time here very soon, I would maybe highly recommend you chat with your broker and your accountant, see if they can maybe talk to each other to ensure that whatever is claimed this year for income is going to help you, not hurt you. I know from experience. So yeah, I know that my mortgage person and my accountant was talking to each other or will be talking to each other based on like what needs to be on my taxes this year because of the way I have my corporation and that kind of thing. So it's just really important. And if we can help save you a headache or two, then we would love to be able to do that.
Especially if you're looking to maybe sell and buy or even just buy in the next few years. If you're self-employed, you definitely want to strategize beforehand. You want to be looking at this like 2 to 3 years in advance so that we can make sure everything is exactly how it needs to be so that it's a nice, smooth process. You can afford that type of house that you're looking for and not have to worry.
Yeah. Because a lot of people in their mid 30s or 40s, a lot of times you're in that transition of like, maybe you're still in your first home and you're like, yeah, it would be nice to have a little bit more space and that kind of thing. So planning ahead and being able to afford that bigger house with a strategy instead of like putting yourself in a financial position to be like cash strapped and mortgage poor. And trust me, it's not fun, I know. And so it's good to plan ahead. And a lot of people, they're not thinking about that because they're like, it's years, like our renewal is years away. But if you have a plan and you have goals, getting the right people in place to help you ensure that that is going to be the end result of your goals, that we can help you ensure that that actually happens.
Absolutely.
I don't know what other questions I had. Fixed versus variable we already talked about that. The bank renewal letters, basically the negotiating part is key, knowing that you can talk to other people and negotiate your rate and try to secure the best deal for you. The banks don't care about you. They care about how much money they're going to be making at the end of the day. So unless you fight for it, they're not going to give you what you maybe deserve. So I highly recommend that. Is there anything else that you wanted to add to that, Melissa?
I think one of the big things that many people don't realize with certain lenders, I'm not going to name any specifically, but often with their lowest rate products, they have something called a Bonafide sales clause attached to it, meaning it's buried in the fine print. Usually they're not going to tell you this up front, but once you've signed for that, you are not allowed to break your mortgage early unless you're selling your house. Does not matter the reason. So if in the middle of your term, you had a new baby, you've accumulated some debt, you need some access to your equity, you're stuck in that mortgage for that entire term, you have no options. And a lot of people don't realize that those types of things exist, and it is not uncommon. I've seen it a few times. There's been people who call me, I've got a bunch of debt, I'm trying to refinance, I want to bundle everything in together. And I say, okay, call your lender. We want to double check what that penalty looks like beforehand. Make sure that we can make sure that we have enough to roll that in as well. And then they find out, I'm so sorry, I can't break my mortgage early. I'm actually stuck in this. And then if they've taken a 5-year term and they're in year 1 or year 2, that's a really long time to be stuck. And their only way out is to sell, which is not ideal for a lot of people. And you can't even sell it to a family member. Like, it has to be an arm's length sale.
Jeepers. Yeah, that is a scary that is a scary situation. I honestly, until we talked about it that one day, I had no idea that was even a real thing. Like, you literally cannot do anything with your mortgage unless you sell your house. So you are forced to sell your house if you want to make changes to your financial landscape.
I don't know why they're allowed, but it happens, and there's more than one lender that does it. And like, we're not just talking these little lenders that nobody's heard of. We're talking like big banks also. So
yeah. And what is it called again?
A Bonafide sales clause.
Bonafide sales clause. So when you're right,
usually word it that way in their commitments, and it's like buried in there. You wouldn't even know. It's they don't, a lot of lenders just don't make their policies well known. And often the people that are providing service over the phone or in the branch, they don't even necessarily know how these products work on the back end, and like even penalty calculations. If you call them and ask them for a specific reason, why did my penalty increase? A lot of times they can't even answer that question. So you really need to have someone in your corner that can help explain those things to you, because otherwise it's really difficult to try and get that information yourself.
And then once you sign it, it's a sealed sort of deal. So, yeah. I mean, if I know what I did when I first received our like just straight renewal, I threw it into ChatGPT and was like, tell me about what this all says and what are the catches and like different things, right? Because you just, if you're not willing, which I was willing to talk to a professional, obviously, but just for my own, sanity and understanding, I threw it in there. So just for your own sanity, like, take that mortgage renewal that your bank has given you or whoever, go to somebody like Melissa and be like, hey, can you go through this with me with a fine-tooth comb and like tell me, what does it say? What does it mean? Is this what's best for me? And, Melissa will tell you, like, based on your situation, you're going to have to give her some information on your life and what's going on in your goals and stuff. But she'll be able to kind of look through it and say, red flag, red flag, red flag. You can negotiate this. You don't need this, especially when it comes to mortgage, life insurance, big no-no. I have other videos on that, but make sure that you're not getting that unless special circumstances, yes. But anyways, if you've got questions about that, reach out to us. But yeah, so I think we've covered a lot. Hopefully this was helpful to you. If you have questions, please feel free to reach out to us, comment on the video below, and we will be sure to answer any of the questions that you might have. We are inside real estate school, so if you've got more personalized questions, you want a personalized approach, head over to realestateschool.ca. SKOOL is how we spell school. And you can get a personalized approach there. We're here and happy to help you. You don't need to, be working with us and under contract or whatever. We just really do want to make sure that you're making great decisions. So
absolutely.
We will see you next month on the next Mortgage Talk with me.
All right. Thanks so much for having me.
Thank you.